Welcome to the Deep Dive. Today we are tearing into the Q3 2025 earnings call for BNP Paribas, really pulling out the essential knowledge nuggets that define the quarter.
Yeah, our mission today is pretty focused. We need to figure out this big gap, right, between management saying, look, resilience, great strategy execution, and the market just, well, reacting pretty negatively right after the call.
Exactly. Share price down.
We've got a stack of results, some regulatory stuff, and this huge M&A story with AXA IM to really unpack.
So we'll kick off with the headline financials, then we'll dissect that specific credit noise that seemed to spook investors, and definitely scrutinize the colossal strategic play around asset management.
Right.
The goal here is to give you, the listener, the context you need to maybe look past that sort of momentary fear and see the longer-term picture.
And that tension you mentioned, that's really the whole story here, isn't it?
Yeah.
Management pointed to a solid quarter, fundamentally. But the market's first reaction, it suggests they really only heard two things: higher risk provisions and that continuing shadow of the U.S. litigation.
Yeah, not the underlying strength.
Not immediately, no. The focus wasn't on the balance sheet's actual health.
Okay, let's get into those fundamentals first then. On the surface, the top line looked genuinely strong, especially given the tricky macro environment.
It did.
Net income, group share, that rose 6.1% year over year, came in at $3.044 billion. And revenue, the net banking income, or NBI, that was also up 5.3% to $12.569 billion.
Those are impressive numbers, definitely. That revenue growth particularly. However, you have to say both figures did slightly miss the analyst consensus estimates, which immediately sets a bit of a negative tone, right? But the real friction point, like you said, was below that top line, specifically in the risk metrics.
We're talking about the cost of risk.
Exactly. It was, significantly elevated.
Yeah.
$905 million. That translates to 39 basis points.
Wow.
And that's a big jump, 24% year over year.
Yeah.
That instantly grabs your attention, the market's attention, and maybe suggests broader credit stress.
But didn't management spend quite a bit of time trying to isolate the reason for that jump? How much of that $905 million was, specific noise versus general stress?
Yeah, they did. A critical chunk was isolated, around $190 million. They tied that to a specific kind of episodic fraud-related charge within global markets.
Fraud-related, okay.
And management was very quick, very explicit, calling this non-recurring. They said it related specifically to receivables financing and should absolutely not be seen as a sign of, broader systemic stress, especially not in private credit, where I think some investors worry about contagion.
But hold on, does that explanation really satisfy a cautious investor? Episodic fraud, isn't that still a massive red flag for internal risk controls? How convinced should we really be that a nearly $200 million loss is truly a one-off?
That's a fair point. It's a necessary challenge. Management's defense, it sort of hinges on two things. First, the specific, contained nature of the loss. One single file, they said. And second, the fact that other major loan books, like personal finance, actually saw their cost of risks stay stable or even go down.
Okay.
So the argument is, if the underlying economy was causing stress, you'd see it popping up across multiple divisions.
Okay.
Right?
Yeah.
Their stance is basically that this charge is more like an operational incident kind of disguised as a credit risk charge, which keeps the long-term credit outlook intact. That's the narrative.
Okay. Shifting gears then to capital, the structure seemed pretty sturdy through all this noise. The Common Equity Tier 1 ratio, the CET1, that key stability metric, it held stable at 12.5% quarter over quarter. And what's kind of remarkable is that this ratio already absorbed the full, 35 basis point capital hit from that big AXA IM acquisition.
It speaks volumes, really. They generated enough organic capital in the quarter to completely soak up a large acquisition. That prevents capital leakage, and it helps maintain their confidence in the distribution policy.
Let's pull the thread then on the divisional performance, particularly CIB Corporate and Institutional Banking. That's usually the powerhouse.
And it was. CIB delivered a genuinely record quarter. Revenue climbed 4.5% to $4.458 billion. And the mix inside that was fantastic in the high growth bits. Equities and prime services revenue surged 17.9%.
Wow, 17.9?
Yeah. And fixed income, currencies, and commodities, FICC, that was also up 3.7%. So that tells you there's strong demand for derivatives, prime brokerage, treasury products globally.
Yet, the global banking revenues that captures advisory deal-making, those were relatively flat, which points to that interesting regional difference you mentioned earlier.
Absolutely. The call highlighted this divergence perfectly. Their U.S. banking platform was a phenomenal performer, 21% growth.
21%.
Yeah, which largely mirrors the kind of robust activity we've seen on Wall Street, right? But contrast that with MEMA Middle East, Africa, and continental Europe. There, the tone was much more cautious. Management noted a definite wait-and-see attitude.
So deals being put on hold.
Exactly. Major corporate transactions being postponed, geopolitical uncertainty, economic softness cited as reasons. So CIB is powering ahead, but it's geographically unbalanced right now.
Okay. Now let's pivot to what I think might be the single most sort of structural positive shift in this whole earnings release, the end of the RWA regulatory cycle. This feels massive, and I'm not sure the market really got the magnitude immediately.
This is the defining long-term story, I agree. It far outweighs that 190 million fraud charge, in my view. Management revealed that over the last 4 years, just finalizing Basel III rules and doing required internal model updates, well, it resulted in a crippling 160 basis point RWA headwind.
160 basis points. Just for context for everyone, RWA is risk-weighted assets. And RWA growth basically eats capital. So that 160 basis points represented required capital usage of, what, roughly 12 billion over that period?
A huge number. And they clarified that this RWA burden was about 2.5 times higher than the average their peers experienced. So it made the recent capital drain particularly severe for BNP Paribas.
Ouch.
But the good news, they announced this cycle is essentially over now. Done.
Okay, so what does the end of that cycle actually mean in tangible terms? How does this change the capital machine?
It fundamentally changes the bank's DNA, you could almost say.
Yeah.
Instead of facing this constant regulatory inflation driving RWA growth, future RWA growth is now expected to align only with organic business momentum. And they estimate that less than 2% per year.
Much lower.
Much, much lower. So this new cycle, as they called it, it opens up enhanced capital flexibility. It provides an organic capital accretion run rate of about 10 basis points per quarter. This is pure capital generation that isn't just being consumed by regulatory compliance anymore.
And that structural change, that puts their target of a 12.5% CET1 ratio, even post-FRTB implementation. It puts that comfortably in reach by 2027.
Yeah, it does.
And speaking of FRTB, that's the upcoming EU trading book capital rule, they kind of hinted at maybe some further relief there too, didn't they?
They did. They noted the delayed implementation of FRTB until 2027. And they mentioned the possibility of further neutralization by the European Commission. Now, if the EU significantly, let's say, defangs those capital charges, well, it essentially eliminates a major future headwind.
Right.
Meaning that 12.5% CET1 target floor might even be hit much sooner than anticipated. This is potentially a game changer for their future distribution policy for buybacks and dividends.
Okay. Let's turn our attention then to the immediate strategic catalyst.
Yeah.
The first full consolidation of AXA IM. This isn't just like an add-on acquisition. This really redefines their whole investment and protection services division, IPS.
It's a bold move, a decisive move to create scale and, importantly, diversify away from the inherent volatility you get with CIB. This acquisition immediately creates the third largest European asset manager.
Third largest.
Boasting a massive 1.6 trillion in assets under management. That makes the IPS division a much, much more significant profit engine for the whole group now.
That's a dizzying amount of money. It really re-anchors them as a powerhouse, particularly in European long-term savings and alternatives.
Exactly. They're now the leader in European long-term savings and, crucially, a leader in alternative assets. They're managing about 300 billion in those, typically higher margin, stickier products.
And the price tag.
The financial commitment was roughly 2.8 billion of invested capital.
Okay. And the expectations for synergies seem pretty aggressive, but they did detail them.
They are targeting 550 million in total revenue and cost synergies by 2029. And importantly, they expect to realize 2/3 of that figure. So about 360 million by the end of 2027 already.
Walk us through that synergy breakdown. Specifically, how much is cost versus revenue?
So the majority, 400 million, comes from cost savings. That represents about 18% of the combined cost base.
Yeah.
Mainly achieved by, merging operational platforms, shared services, the usual stuff.
Right.
The remaining 150 million is revenue synergy. And that comes from two main places. Internalizing services, like CIB security services that maybe AXA IM previously outsourced, and then accelerated cross-selling of the new, broader product range across their wealth management client base.
Got it. And what's the ultimate payoff for this massive investment, especially considering those hefty integration charges, about $690 million, that are mostly going to hit the books in 2025 and 2026?
Well, the deal is expected to deliver a significant uplift, they said, more than 50 basis points to the group's return on tangible equity, the ROTE, by 2028.
ROTE being key for efficiency.
Absolutely. It's how efficiently they use shareholder money. And they project the actual return on this specific invested capital to hit 20% by 2029. So, yeah, it's expensive in the short term with those integration costs, but the long-term margin story looks very strong on paper.
So they're buying growth and scale with AXA IM. But let's look at where they're sort of grinding out returns in the engine room, their core commercial units. Beyond the acquisition, they're also targeting major profitability improvements in CTBS commercial, personal banking, and services.
Yeah, this is key for showing they're also focused on domestic margin improvement, not just buying scale. They're targeting significant upgrades for core units, like their Belgian retail unit, CPBB. The aim there is to raise its return on equity from about 13% in 2024 to an ambitious 20% by 2028.
20% in Belgium. Wow.
Yeah, and they have similar plans for their operations in Poland, PKO Bank Polski.
So that shows a kind of unified strategy, doesn't it? External scale with AXA IM, but combined with rigorous internal optimization in their home banking franchises.
Precisely. They're making sure that the, roughly 1/3 of the group's RWA base sitting in those core European units starts driving much higher profitability going forward.
Okay, but here's where we kind of circle back to the elephant in the room. The thing that really fueled the market pessimism, I think. The CEO actually led the call by addressing that U.S. jury verdict from October 20th related to the Sudan litigation, events from over 15 years ago.
Yeah, the litigation shadow is clearly the single biggest source of headline risk right now.
Yeah.
And, stock underperformance. Management came out swinging, really, stressing their high confidence in overturning the verdict on appeal.
They called it fundamentally flawed.
They did, specifically citing issues around how Swiss law was applied and what they see as a lack of causation evidence.
Okay, but playing the cautious investor again. Appeals are uncertain, they take time. What assurance did management actually give that this won't just metastasize into some huge open-ended financial headache?
Well, they provided crucial clarity on the scope. They emphasized that the damages awarded were specific to just 3 individuals. And crucially, they stated, quote, extrapolation is not permitted.
Okay, that's important.
Very important. It means any future claims have to be assessed individually. You can't just multiply this initial verdict. It's an attempt, clearly, to neutralize that fear of some massive, unquantifiable fine down the road.
Right. And despite all this noise, the provision charge, the legal uncertainty management confidently reaffirmed their 2025 net income target, still aiming for greater than $12.2 billion. And they reiterated that robust 60% distribution policy too. Split 50% dividend, 10% buybacks.
But that just boils down the divergence perfectly, doesn't it? Management is focusing on the strategic execution, the huge scale from AXA IM, the capital freedom from the RWA cycle ending, that robust CIB quarter. But the market, at least initially, seems fixated on the transient legal and credit noise.
Valuing the noise over the structural drivers.
Seems that way in the short term, yes, leading to that negative price action.
Well, that stark disconnect brings us neatly to our final segment.
This is not financial advice. Just a reminder, this segment is purely for intellectual exercise. We're identifying a wild, maybe, but plausible trade idea derived solely from the information we've just chewed over.
Okay, pitch the idea then. What stands out as the most potentially undervalued factor in this whole earnings report?
Okay, I'm pitching the post-noise synergy long. The basic idea is the market is currently pricing in pretty much the absolute worst-case scenario for that legal overhang. And it's focusing entirely on those non-recurring provision items, specifically that $190 million fraud charge.
Right.
This means, I think, the fundamental strengths like the CIB record quarter, the stable capital, that positive jaws effect, where revenue growth is really outpacing cost growth, all that's being overlooked. The stock is heavily discounting future value right now.
Okay, so what's the actionable thesis then? What justifies actually going long?
Go long BNP Paribas, betting on a powerful convergence of, say, 3 factors by 2027. First, you need a successful appeal, or at least a favorable resolution of the Sudan litigation. That relieves the major headline risk.
Okay, factor 1.
Second, the successful realization of, let's say, the first 2/3 of those $550 million in AXA IM synergies. That flows directly to the bottom line, accelerates the ROTE uplift we talked about.
Makes sense. Factor two.
And third, the positive shock. Maybe the market hasn't fully priced it in of that RWA regulatory inflation cycle ending, freeing up capital faster than anticipated, which then fuels the distribution policy, maybe even more aggressively.
So in essence, the argument is the short-term price dip gives you a compelling entry point if you have, say, a 2-3 year horizon, and you're willing to look past the integration costs in 25 and 26, betting that strategic execution eventually overcomes this regulatory drag and noise.
Exactly. It's fundamentally a bet on capital generation and structural scale, winning out over what seems like episodic noise.
Okay, so to wrap things up then, the core tension really remains. We've got these solid underlying results, a clear strategic direction, massive scale in asset management, that pivotal shift in the RWA capital cycle. And that's pitted against, well, short-term credit noise and these litigation fears.
Yeah, and the critical takeaway for you, the listener, is probably management's clear strategic commitment. They confirmed that greater than 12.2 billion net income target. And there's this intensive focus on accelerating profitability in those core European banking units, Belgium, Poland mentioned specifically.
Right.
These are the fundamental levers they're pulling, designed to hopefully re-rate the stock once all this noise dissipates.
And here's a final provocative thought for you to mull over. If the EU definitively neutralizes that FRTB capital charge, which, management hinted has maybe a better than 50% chance of happening, does that 12.5% CET1 target stop acting like a restrictive ceiling?
Interesting point.
Could that capital relief actually become a launch pad for maybe even more aggressive accelerated buybacks, potentially bringing that full 60% distribution policy to the forefront much earlier than management is currently guiding?
That structural capital question.
Yeah,
that's certainly worth monitoring over the next few quarters as we wait for that regulatory hammer to drop, or perhaps not drop, as the case may be.
absolutely. Well, thank you for joining us for this deep dive. We hope you feel well informed and ready to tackle the market. We'll catch you on the next one.